You're listening to CFRN, a community of believers who trade for a living. To learn more about who we are, what we do, and how we do it, call toll-free 1-866-928-3310, and we'll send you out a no-obligation information kit absolutely free. 866-928-3310. The CFRN Emini Futures Cast is now on Stitcher. Listen to us on your iPhone, Android phones, BlackBerry, and WebOS phones. Stitcher is smart radio for your phone. Find it in your app store or at Stitcher.com. Stitcher Smart Radio, the smarter way to listen to radio.
Are you ready, Steve? Andy? Yeah! Bert? Well, all right, fellas. Let's go!
You're listening to CFRN, the Christian Financial Radio Network.
Today's broadcast is brought to you by Audible. Get a free audiobook download at www.audibletrial.com/CFRN. Over 85,000 titles. Choose from mystery, romance, religion, science, technology, business, New York Times bestsellers, even children's books. You name it, Audible has it. With 85,000 titles to choose from, you're sure to find the perfect audiobook for yourself or to give as a gift, and it's absolutely free. Just point your browser to audibletrial.com/CFRN. That's audibletrial.com/CFRN. And become a part of the audiobook revolution by downloading your free audiobook today. audibletrial.com/CFRN.
Hey, trader, want to get rich quick? Well, good luck with that. If, on the other hand, you actually want to learn how to trade, the place to be is www.cfrn.net. Tune in Monday through Friday, 9 a.m. Eastern for our daily devotional, and then spend the next 3 hours learning how it's done from professional traders who actually trade for a living. That's www.cfrn.net. Every trading day from 9 a.m. to 1 p.m. Eastern. CFRN, a community of believers who trade for a living.
Good afternoon, traders, and welcome back to the CFRN Emini Futures Cast. This is the daily broadcast of Indeterminate Length, where we discuss all things Emini, along with some really big ideas on the finer points of trading gold, bonds, crude, sugar, the euro, and even T-bills. Joining us today from our studios in Boston, Mr. Michael Borth. From our trading desk in Chicago, Mr. Burton Schlichter. Now, to get things started, let's go to our host and founder in Studio A, overlooking South Mountain, America's largest city park. Here's Dwayne.
Good afternoon. Welcome back. Today is Wednesday, 24th day of July, 2019. Thanks so much for joining us today, whoever you are, wherever you are. We're just glad to have you right here, right now. If you cannot see the chart I have up, go to our homepage at cfrn.net. On the right-hand side of the page, click the big microphone, follow the instructions. You'll be registered in about 30 seconds, and you'll have one-click access to the show each and every day. On the days when you're out of the office, away from the desktop, and you want to join the show, go to youtube.com/CFRN/live. There you will find a live real-time simulcast of the show as it unfolds, brought to you by the good folks at YouTube. Thanks, YouTube. All right. Chart, S&P 500 Emini Futures. That is one of last week's weekly trading zones that got in our path today on the way up. Here's the opening candle. 9:30 Eastern. These are 30-minute candles. So from 9:30 to 10, we went from basically one of last week's zones to another one of last week's zones. Of course, this week's zones were delivered to the partners Monday morning, 6:15 a.m. Eastern, as we do each and every Monday. The weekly trading zones have been published since December 14th of 2009. Yeah, long time, right? And their behavior, interestingly enough, hasn't changed. The principle, the underlying foundation of markets, the rhythm, if you will, hasn't changed since the markets were created. That's a big, big, gigantic statement, but it's one I stand by, and it has a lot to do with everything our methodology, our strategy, our indicators are built upon. Something that doesn't change. We always hear markets are ever changing, always evolving. Okay, I don't completely disagree with that. But the underlying foundational principle upon which markets operate has not changed, will not change. It is the rhythm of the market, the rhythm of the universe. It's something that God baked into the cake somewhere between Adam and zebras. Now, who's going to mess with that? That's just it. No one can. So, with that said, let me give you the numbers from around the world. We'll go to Michael, get a recap of everything that happened in the live training room. And then I'll be back. We'll talk to John, answers to your questions. We'll take a look at Concierge Trade Alerts from last night. Let me give this one little bit of news here. Mercedes is building a crypto hardware wallet for cars. Per the release, car wallets have a wide variety of use cases, such as car sharing, autonomous vehicles, real-time exchange of secure traffic data, and with smart city environments to reduce congestion and lower insurance premiums. I hadn't thought about this. Autonomous vehicle pulls up to the toll booth. We don't have any toll roads here in Arizona, but I have visited a toll booth on occasion back east. If there's no driver, who's going to put the money in the cup? I guess they have the decals that you can just put on the dash and they scan it as you come through. Or you can pay out of your crypto wallet, I suppose. Autonomous cars, this is a comment by the CEO, Tom Firstner, the startup that's working together with Mercedes, Riddle and Code. Riddle and Code. That's the name of the startup. Do you get it? You see what they did? Riddle and Code? Okay. From the CEO, autonomous cars must behave consistently to be trusted. Cars are already computing devices. A secure identity ensures that the right authorities have approved code executed inside vehicles and the trustworthiness of data exchanged. Riddle and Code secures this with its cryptographic hardware and uses ledgers to turn automobiles into future marketplaces. End quote. The wallet in question is reportedly built around the startup's own secure data storage solution. It's called Secure Element 2.0 and allegedly provides a secure blockchain-based identity for vehicles. According to the release's author, merging this kind of identity with a state-issued vehicle identity, your car registration, would enable unique and secure ledger transactions. A press release issued back in February also revealed that Mercedes-Benz has developed a platform based on blockchain technology to increase transparency and sustainability in complex supply chains. Furthermore, in January of 2017, Mercedes-Benz acquired digital payments startup Pay Cash Europa, spurring rumors that the giant is in the process of launching a payment service of its own. Reported earlier this month by Cointelegraph, self-proclaimed electrification, automation, and digitalization global giant Siemens has shown an interest in adopting blockchain-based solutions. In particular, Siemens is exploring the use of blockchain in the transportation industry. IBM is already doing that. Okay, so your next Mercedes just may come with a built-in crypto wallet. Let's go to the numbers. These are the numbers from around the world. These are cash markets. Starting here in the US of A, the Dow is currently down 115 points. The NASDAQ is up 18. S&P 500 is up 1.25, and the Russell 2000 is up 5. In the commodity basket, crude oil down 7 cents. We did have crude inventories today, and let me just give you a peek at that. Zone. Gold up 20 cents, trading 14.2190 last. In the Asian markets at the close, the Nikkei was up 88 points. Shanghai was up 23. That's almost 1% for the Shanghai. And the Hang Seng closed the session up 57 points. In European markets at the close, FTSE down 55, DAX up 32, and the CAC down 12. No movers and no shakers there. That gives us a green day in Asia, a mixed day in the UK, and it is a mixed day here in the US of A for now, with the Dow being the only one of the major indices underwater. Let's go to Michael and get a recap of everything that happened in the live training room this morning, and then we'll be back. We'll take a look at the Concierge Trade Alerts. We'll talk to John, all that and more.
Okay.
Morning, Michael.
Good morning, Dwayne. Good morning. And it was a good morning.
Right. Excellent.
Yes. All right. So here we go, guys. Today is Wednesday, the 24th day of July, 2019. If you have not taken a free trial with us, go to the homepage at CFRN.net. Excuse me. Go to the homepage at CFRN.net. In the right-hand column, it says 5-day free trial. Apply.CFRN.net. If you click on that, it will bring you to this page. Or you could just go directly to this page, eminitrainingschool.com. Anyway, on this page, all we ask for is your name, your email, your phone number. Tell us your biggest trading challenge, so when we do one-on-one training with you, we'll be able to tailor it to your biggest trading challenge. Hit the send button, and you'll be sent everything you need to get into the free trial. Okay. Now, this morning, we had another green day. If you're going to read the spreadsheet, you can read all the CFTC risk disclosures down at the bottom. Today is the 24th day of July 2019. We made 10 ticks in the euro, 10 ticks in crude, 8 ticks in gold. That put us at 242.5. Today it took 65 minutes and 6 trades to get to the goal for the day. At that point, we're up $105 a contract, and we took a total of 9 trades this morning. On the month now, we're up $2,400. That's over 17 days, averaging $141 per day. On the year, we're at $16,947. That's over 130 days, averaging $130 per day. The symmetry, it keeps going. Yesterday it was 129 days, $129 a day. Today it's 130 days, $130 a day. I love it. Anyway, let's get into what we did or didn't do. Okay, so gold started off. We missed a shorting opportunity right here. That would have been a winning trade. Started off there. And then we picked up, on this one, we picked up 6 ticks. And then 2 more ticks, put us at +8 on the day. During the break, Just looking at it here. During the break, there was a shorting opportunity right here for that leg down. And that's all there was on the gold today. Okay. On the euro, well, right here on the euro, we started off with the +4. And then we came down here and we got 6 more to put us at +10. And that was it. There was nothing during the break here. Nothing at all during the break. So we ended with +10 on the euro this morning. Okay, on the crude. Now we had crude inventories come out today, and it bumped crude all the way up here to 57.64. We want to see it get up to like 61 this week. But it was going in the right direction, and then it turned around and started going in the wrong direction. Let's see. Hang on. In here, we had a break even on crude. Then we had another break even on crude. Then we missed a long trade that would have worked out for some profit. Then the inventories came out, and then we grabbed 10 ticks right here. And then we had another break even here. I could have grabbed another 10 ticks on this, but I totally forgot I had the trade on. And when I realized it, I moved my stop to break even, and it took me out of break even. All right, since then, crude has really taken a nosedive. It dropped through this weekly trading zone and just kept going. And then it came back to the weekly trading zone, and now it's dropping through it again. There was a shorting opportunity right here during the break. Okay, now we want to see crude get back up to 58.5 by tomorrow. 58.5 by tomorrow. All right, on the ES, we just had this one break-even trade here on the ES. There was another one here that we missed that would have stopped out for sure. And another one here that would have been a break-even at best. During the break, there was nothing on the ES. Okay, we're just not trending. Step one is make sure you have a trend. Okay, and we did not have a trend in there. So that is that. We'll go back here to this, and let me see. Okay, Gary P. You talked to Valerie, so you have all the information you need, right? All right. If you're going to read the spreadsheet, you could read all the CFTC risk disclosures down at the bottom. Today is the 24th day of July. We made 10 ticks in the euro, 10 ticks in crude, 8 ticks in gold. 242.5 on the morning session, over 65 minutes and 6 trades. We got our goal for the day. At that point, we're at 105, and we took a total of 9 trades. So on the month now, we're at $2,400. That's over 17 days, averaging 141 per day. 141 per day. On the year, we're at $16,947. That's over 130 days, averaging $130 per day. Okay, now that is one contract, 2 hours per day. All right. The goal is not to make $130 a day. The goal is to have multiple contracts. Okay. If you can make $130 a day every single day, or average $130 a day throughout the year, then that's all you need to do. You just need to add zeros on there and add contracts on here. Okay. You build your account by making money. All right. All right. If you have not taken a free trial with us, go to the homepage at CFRN.net. And over here on the right-hand column, it says 5-day free trial. Apply.CFRN.net. When you click on that, you'll be brought to this page right here. EminiTrainingschool.com. You can go directly to EminiTrainingschool.com if you want to, but if you click on that link from the homepage, then all we ask for here is your name, your email, and your phone number, and tell us your biggest trading challenge. Hit the send button, and you'll be sent all the information that you need to get into the live training room every single business day until you cancel. Okay, and with that, we can pass it back out to fabulous Phoenix, Arizona, overlooking South Mountain, America's largest city park. Dwayne, if you are ready.
I am.
Okay.
Okie doke. Recap of the recap.
Today it took 65 minutes and 6 trades to get to $105 per contract.
65 minutes, 6 trades to get to
105 per contract.
based on one contract
That is correct.
operating inside of a 2-hour window.
Mm-hmm.
Outstanding. Bingo. Very good. Okay. I spoke to Garrett. Garrett's going to join us here in a bit. I
Okay.
didn't speak to John, but I would guess that he is going to be dropping in here pretty quickly. I might should have dialed him up, but we'll just take a look at the Concierge Trade Alerts. Any questions in the chat box?
No questions at all.
Daily Double has not gone out yet, guys. I want to just, I looked at it, and I looked at it again. I kind of tilted my head to the left, and I tilted it to the right. When I have to look too much, I have to stop, because I don't want to manufacture something. If I were going to manufacture something, I would say, let's see. Yeah, today's Wednesday, which is really close to Thursday. So I think I'll just adjust these weekly trading zones right here, right now. All right. So we have a weekly zone at 0203, which is right here. $2,002. No, 03. There we go. So I know you were in the room this morning, so you didn't have a chance to listen to any of the Mueller testimony.
No, I did not. But the markets were, I mean, when he was testifying, the markets were just really nasty. They're just really sideways markets for, I don't know, probably 45 minutes. It seemed like the last 45 minutes.
So that radio freebie, guys, 3010 to 3012. If I were going to do a radio freebie today. Cup and sitter. Okay, let's try that again. There we go. All right. So we don't have a zone this week at 11:12, but this really shows you the carryover effect of the zones. Even though today is Wednesday, and we issued new zones Monday morning at 6:15 a.m. Eastern. Well, here's 11:12 doing its job 3 days into the new week. So as I make the new zones available, if you're not yet a passport holder, if you're not yet a CFRN partner, when I make them available to the entire community on Thursday and sometimes Wednesday, you would do well to jot them down because you'll begin to see over the coming days how they will can impact your trading. So let's take this. See, we've got no 11:12. We jump all the way up to 21:22. Okay. And this one, we're going to take that down to 29.83 / 84. So that's going to be right here. All right, so these are this week's zones, 2983/84, some of them. And then 3002/03. And then above that, we've got 21/22. So let's tighten this up a little bit. All right, Sunday was the 21st, Monday the 22nd. Yeah, let me correct this. Okay. All right, so this is going back into last week. That was Friday. So Sunday night Globex Open is going to be right there. That little inside candle. And why do I call it an inside candle? Well, this was the final candle last Friday. This was the Sunday night Globex Open. We had an inside candle there. And that after this waterfall on Friday, that inside bullish candle, that is called a trying to think of the Japanese term for it, woman with child. Okay, it'll come to me in a minute. If you want to look it up, you could always Google CFRN, The Secret Life of Candles, and there you'll find a slide presentation that walks you through 10 of the major candlestick signals. There's actually hundreds of signals and patterns, but really only 10 major ones. Some of them you might see once or twice in a lifetime. They're that rare and obscure. But the top 10, you'll see them day in and day out. All right, so this is a bullish candlestick setup, and so we get a leg and a retracement and a leg and a retracement, leg and a retracement, a leg, and it just keeps going, right? Now, at this zone 8384, what do we have below that? Below that's way down at 59/60. So I'll go ahead and get that one on here. Don't know that we'll need it this week, but I'll go ahead and put it on the chart. Remember, only three things can happen when price reaches a weekly trading zone, and it's been that way since the beginning. The most likely thing to happen is consolidation. Some call it coiling, amounts to basically the same thing. It's this: price gets to the zone, consolidates, and then remember, price is always trying to get to a zone, either the zone overhead or the zone below. Your job, your mission, if you choose to accept it, is to determine which zone is price trying to get to. Our indicators and our alerts, both the static report, Concierge Trade Alerts, and the dynamic in the moment alerts, Logic 247, help you see and understand what price, what the market is trying to do. Zone to zone. So from 84 to 02, is that 18 points, Michael?
84 to 02?
Mm-hmm.
Yeah. Yeah, that's 18 points, yep.
Okay. So that's an 18-point move from zone to zone. And you'll notice that somewhere in the mix here this week, I'm not sure if it was a concierge or logic, doesn't matter. The alert said to consider buying $29.95, because at this point, we're pretty sure that price is trying to get to the zone overhead at 0203 versus the zone below at 59/60. Didn't quite make it on the first pass, but what did it do? It came back and it got below the trigger. Important prices, important areas are almost always tested. I said this consolidation is the most likely thing to happen. The second most likely thing to happen is rejection. And the third most likely, and the only other thing that can happen, is what I call the slice. That's when one of these 30-minute candles just rips right through a weekly trading zone as if it weren't even there. Now, when that happens, we expect price to, or what we see most often, price will come back on a up move. Price will, once it slices through, it will pull back to the zone it just sliced through, confirm that it is now going to be good support, not the resistance we expected here, confirms good support, and then continues in the direction of the slice. Now, for those partners and passport holders who had their little notepad by their keyboard, they were able to glance over as price was coming up and know that we're heading into, getting close to one of last week's zones, because this week, the next zone overhead is quite far away. From 3003 to 3021, I guess that would be 18 points also. Is that correct?
That is correct.
Okay.
That is correct.
All right, so we come back, we make another run right there, we come back. Now, this is a little unusual, okay? Because price has demonstrated here that it's really trying to get to that zone overhead. It's still trying, okay? Falling back like this, this was the London Open on the 24th, today. Right here, London Open took us down for whatever reason. We didn't quite get back below the trigger here. Price was trying, okay? So this is a little bit of an anomaly here, but it happens. So here we go with a leg and a retracement. Now here we got that same slice, but the slice has lost some of its drama because we already had a slice here, and this held as good support on the pullback. So this time we don't pull all the way back to the zone. We pull back to 3,475. And now we're marching. There's no guarantee that price is going to get to the zone overhead, 3021/22. I think, however, everyone would agree, just looking at this and not really knowing anything about zones, just a casual observer, a civilian, if you will, would say, looks like if it's got to go one place or the other, looks like it's trying to go here. I'm more convinced that it's trying to go to 2122 than I am convinced that it's trying to go to 83.84. Now, with an 18-point window of opportunity between zones, there's certainly plenty of room there to pick up your goal for the day. We work with a 2-point goal each and every day in the live training room, and we do that for a reason, a very good reason. You can make whatever money it is you want to make, that you envision making. Well, number one, you got to have the skill set to make whatever money it is that you want to make. But any dollar amount within reason, and that's a pretty big reason, can be done with 2 points. As Michael pointed out this morning, 2 points on one contract turned into $105. Okay. If he were trading 10 contracts in the room, which we don't do, but if he did, then that $100, $105, I think it was, would become 1,000. 10 contracts. Okay, that's 2 points. Same 2 points. And I can't stress that enough. The exact same 2 points that allowed him to rack up $100 with 10 contracts would allow you to rack up $1,000. And 100, well, you can do the math. Now you might go, yeah, but you can't really trade 100 contracts. Well, with the S&P, you actually can. And that's why so many people are drawn to it. The liquidity, the round-the-clock liquidity. You never have to worry if you're going to be able to find somebody to take the other side of your trade with the S&P. If you want to get long, there's somebody that'll sell you a contract. If you want to get short, there you go. Whatever you want to do, there's always somebody, whether you want to go long or short, based on your analysis, there's always somebody willing to take the other side of that trade. Now here's a DOM, and you can see here we've got auto sum turned on. So this represents 260. It's ever changing. There's 3,000 going 10 levels deep. There's 3,622 contracts at the moment. There was on the bid side. On the ask side, it was about 4,000. Okay, and that's just going 10 levels deep. And also, there's a thing called iceberg orders, which means if you're trying to buy or sell a large number of contracts, you may not want to tip your hand to everyone at the table, so you only show a small portion of that order. But the computer understands, and when the 10 you're showing gets filled, the other 90 slide right in behind it, or 900, whatever the case might be. So with 4,000 on the bid and basically 4,000 on the ask, back to the question of could a person really trade 100 contracts? The answer is yes. And during the day session, when we have the most volume, it's possible right here, right now, to trade 100 contracts without any slippage. Always factor in slippage. When you start to trade a large number of contracts, just accept the fact that you probably won't get filled at the same price on all 100 contracts if you were trading that large. But as you can see, it's very tight, so whatever slippage you got should only be one, at the very most, couple ticks. Okay. During the overnight session, during the Globex, we don't have quite as much volume and quite as much participation, but the overnight market has become a market unto itself. Back in 2005, when I first started trading Emini Futures, nobody ever really talked that much about Globex, the overnight session. And we knew it was there, but it didn't garner a lot of attention. I've been telling everyone for years that the London Open, 3 a.m. Eastern, provides some really fantastic opportunities to get long or short in a number of different markets. All of the good characteristics that we find around the Wall Street Open at 9:30 a.m. Eastern are present in the London Open, but it's not quite as choppy, or it's not quite as herky-jerky. Once the London market opens and price finds a path, it tends to continue in that direction, at least for a period of time. Now, we had a pretty smooth open. Well, I don't want to say smooth, but this is the opening candle right here for Wall Street, 9:30. And here's the London Open. So London opened at 3,002 and a quarter, and we dropped to 29.96. So a very nice opportunity there off of the open if you're trading London to pick up your points for the day. And today, again, we can't see what happened inside of this 30-minute candle unless I went to a smaller time frame, which I actually could do. So let's do it. All right. ES. I've got to have an S on my keyboard somewhere. There it is. All right, so we'll move this out of the way for a moment. And we'll drop down to just a 1 minute chart. We don't use the 1 minute chart too often, but let's see what we got. So we're going to back up to the 9:30 open. 9:30, right here, this candle. For a Wall Street open, That's a pretty smooth move, as they say. Took us from 3,000 up to 3,011 and a quarter, right to that zone from last week. Now if we back up to, and again, that's a little unusual for the Wall Street Open. That looks kind of more like a London Open. Let's back up to 3 a.m. Too far. (3 a.m.) the 24th. So right there, London Open. Leg and a retracement, and a leg and a retracement, a leg and a retracement. And there you have it. And that leads you right into the Wall Street Open. Swing high so far here, 3,011. So if you're on this ride from 3010 to 3012, don't want to get ahead of ourselves, but that bell's for you. All right. Let's take a look at the Concierge Trade Alerts from last night. So hopefully what I just walked you through helps you to understand a little bit how zones play into this, alerts play into this. This information I just gave you here plays into this, and then also this plays into it. Okay, bullish cross right there at the zone. Now, some would look at this and go, the market owes us a pullback. Well, that's one way of looking at it. But remember, the market never owes us anything. We owe everything to the market when it comes to things market related, because it's the driving force. We're not. We have no ability to change the market in any way whatsoever. And some will say that, well, with the S&P, you got to have really deep pockets to move the market. Yeah, there may be fragile times when a really large order can sway the market for a bit, for a moment. But there's just too many participants, too much volume. When you start, and we always hear things about, oh yeah, they ran my stops. That's just, it's an urban myth, legend, whatever you want to call it. Because when you start doing the math, okay, how many contracts would they have to buy or sell to move price all the way over here to take out that stop loss on that one contract order? I mean, it just doesn't add up. You can feel free to use a calculator. It doesn't. So these things get spoken, people buy into it, because again, when things don't go our way in the markets, natural response is to figure out who messed up. It sure wasn't us. Could be the market, could be the broker, could be any number of things. So having that, oh, they ran my stops, that's sort of a cover-all panacea. It's a way of not having to take responsibility for whatever happened. Now, when I talk about taking responsibility, it's not about you being right or wrong, because the market is going to do what the market is going to do. And what you're looking for is simply the highest probability thing for the market to do next. So after the bullish cross, price gets above the BBC, just stands for bull bear cross. When price is above it, we're bullish for whatever time frame we're observing. We anticipate higher prices. And when price gets below it, we anticipate lower prices, again, for whatever time frame we happen to be looking at. Okay. Now, this business about the market owes us a pullback. Again, the market doesn't owe us anything, but what we do know is price always reverts to the mean. And in this case, the mean is the BBC. Okay? Price will come back here. When it does, the BBC will hold the pullback. And what do I mean by that? Well, let's just look here. Your bullish cross, price pulled away, price pulled back to the BBC. And yes, this candle did open and close, not touching the BBC. But we're always so quick to take action. And I find if I just wait another minute in so many cases, in this case it might be 30 minutes because we're using 30-minute candles. If I wait a minute, if I jump the gun here and say, well, the BBC failed to hold, I'm doing myself no service, plus there's no trade setup there. The next candle shows us that the BBC did hold. So it gave us a leg, we pulled back, we reverted to the mean, and it held, sending us up for another leg. We pull back, it held, we get another leg, pulls back, it holds, we get another leg, it pulls back, and it holds. A leg and a pullback, it holds. A leg and it didn't hold. It holds more often than it doesn't. When it doesn't, no shock, no freaking out. We understood coming in that while it holds more often than it doesn't, there'll be times when it doesn't. And this is that instance. It didn't hold here. And then when we pulled back here, it didn't hold here. Okay? It didn't hold. It didn't hold. It held, it held, it held. Okay? All right. So the question now is, will we get to 3012 before we pull back to the BBC? I don't know. We're going to find out. Swing high so far is 3011.50. So we need 2 ticks above that high. Once we hit 3012, which will be basically a little double top right here on the 30-minute chart, I would start looking for that pullback. And once it pulls back, I expect that it will hold until proven otherwise, and that we will wind our way up to this 2122. Unless there is some tweet or some breaking news that gives the market a reason to sell off. Because the market is always looking for some fuel to throw on the fire, something to send it higher or lower, something it can move on, trade on. In the absence of it, then you just have buyers and sellers hitting the bid, hitting the ask, and price moving accordingly. Okay, this market's in no real hurry to go anywhere right now. Let's peek just real quick at the daily chart. Okay, remember I talked yesterday, as we pull up to, on the daily chart, as we pull up to the red CFMA1, we expect that to be good resistance. It held the market in check quite a bit yesterday. And then I said, if it doesn't hold, we would expect to go up and challenge this swing high, which just happens to be at 23.5, all-time historic high. You know what? I'm on the at ES. Let me switch it to the current contract. Yeah, 23.5. Just want to make sure. So looking at the daily, now that the market has made it through this resistance, I'm looking to, okay, where's the next obstacle? Because remember, the market's always trying to go somewhere, do something. So we got this all-time historic high at 23.5. And we have a weekly trading zone at 21.22. So if, in fact, what I just said turns out to be the case, then we have no real worries about this. The only consideration you have to make here, when will the market attempt its pullback? Will it happen before the session closes today? Will it happen tonight? Again, these are things we don't know. But we know that the highest, my interpretation of the market, my narrative, clearly told me that from where I put this up on the screen, The highest probability thing was for the market to go up and challenge this swing high. Okay, challenging doesn't mean touching it or exceeding it, just means attempting. Okay, so this swing high is 1275, and we got a swing high of 11.5 so far. Once it gets here, I would be very reluctant to enter another long trade. If I were in this, I certainly might consider trailing if possible. But once we go up and test this, see over here, this little double top, okay, and then we pulled back, I would expect a similar kind of thing to happen here at this double top. Okay, that's if the market has enough of the right stuff to get there. Then I'll look for the pullback, and then on the pullback, look to enter long. Okay, all right. So I said we would look at the Concierge Trade Alerts. Anybody seen John or Garrett?
Neither one.
Okay.
Nope.
All right, no problem. I'll just keep cranking.
I've been looking.
All right. If you want to grab a screenshot, guys, of last night's trade alerts, they got out at 6:20 p.m. Eastern. The S&P, we were looking to be long at or above 3012. Okay. And there was 3012.75. So we tiptoed 3 ticks over the line, and then we pulled back. So we're headed for a second trigger at that 3012. Okay. On the short side, we were looking to be short if the market dropped to 29.95. The swing low was 29.96. This would be what's considered a no trigger because price didn't touch the trigger point, 29.95. Okay, on the Dow, last night we said consider being long 27,400. We can see that didn't happen. Consider being short 27,240. Okay. Now these are last week's zones also. So let me clean these up. 27,285. Oh, come on now. 285. Okay, I give up. Okay, 280, 285. And below that we've got 160, 165. Okay, and then overhead we've got 280, 27, 425/30. Okay, we'll just take this off for right now. All right, so the Dow did not trigger on the long side, and the short side said to consider being short at or below 27,240. So that's right here. Triggered there, retracement, had a leg, hit that important price, important area, retraced back up to the weekly zone where it confirmed that it would now be good resistance. Coming down, we expect it to be good support till it isn't. Over here, we can see what it looks like when it's good resistance. We can see here again, there's that good resistance. We drop back below the trigger and we put in a swing low at 204. So that's 36 points. We then get back above the trigger, trigger again, back above the trigger, trigger again. So this swing low took us all the way down to 27,175. And this move down took us to 27,181. And again, the trigger point, 27,240. Now, on the Concierge Trade Alerts and the Logic 247, we don't like to risk more than $300 per contract to find out if our idea of the next high probability move has validity. We don't want to risk more than $300 per contract. We want to risk less if we can. So we do teach our traders a 3-step process. You look at 3 different charts to determine the best stop loss placement for any particular alert, be it Concierge or Logic. That you, Garrett?
It must be Garrett. It's not me.
He comes in with a hot mic.
Yeah, it's Garrett.
Okay.
I will check in with you in a bit.
Go ahead and hit mute on him for just a second. He probably doesn't realize
Okay.
wait, hang on, maybe he's coming right now.
Oh, okay, I just mute him. I'll unmute him. Hey, Garrett.
Hey,
Hey, Mr.
There he
Garrett,
is.
welcome to the show.
hey, thank you. How are you? I'm sorry, I had a couple of calls there that got me on a little. I hope I'm not too late.
No. No, we just been yakking about the markets as we do.
Yeah. Well,
What
it's.
do you think? What's going on?
I'll show you if you can grab my screen here. I'll show you what I think's going on.
Okay. Here come the charts coming at you.
Let's see. Show my screen. It says so. There we go. Now let's see if we can get on my right screen. I don't know what.
I'm seeing the connected to GoToWebinar screen right now.
Let's do this.
Ah. Now see the chart you want us to see, S&P 500 cash index daily.
Yeah. Let me see. Maybe I can. I'm going to try and move the. Let's see if. There we go. I've got the thing that says I'm on the thing here. Now I can see it. Can you see the whole chart, like where my cursor is here?
I can. Yes, I do.
Oh, good. Okay. Let me just kind of go through what I'm obviously this is the S&P 500 cash index going back a couple of years. This first is the January 18th top where this arrow is. The second arrow is the September 21st top. And those are two pretty historic tops, particularly in the near term. And this is just a line that connects those two tops. And so it's a very valid tops line, and by and large, this line shouldn't be penetrated easily, frankly, because of where we are and how much it's taken to get here. But that's what that line is. This line here, the question might be, oh, gee, you started it over here at this top. Why didn't you use this one or this one? What's so significant about this one? That's the November 7th top, so it is a fairly significant top. But the significance of this line is it catches these 2 points, it catches these 2 points, and it catches a point on either side of this high. So it's a pretty valid line. If you want to further confirm the validity of the price angle, which is what a trend line is, you parallel it down here off this low prior to the Christmas low, and you come through and hit this high and this low and this low and this low. So you're hitting some pretty good points and a pretty significant low over here with the parallel. So it's a pretty valid line. So bottom line is you got a couple of pretty valid trend lines. The fact that they meet right about here, which is at the end of the month, is pretty significant, and that has a tendency to draw price to that level. The arrow that I've got here represents basically today, what it's intended to represent, I should say, is today, tomorrow, and Friday, which would be right where this vertical line is right here. That's Friday, and that's because I have a number of things coming together in other work that would imply that that would be a reversal period. And since things have been going up, I'm assuming that it would be a top. There's a little red dot in there, and that's kind of the ideal target zone. And that's, as I recall, about 30.22 to 25. So somewhere in there, I think that would draw price. It can go higher than that, doesn't matter. What I'm looking for here would be a higher high, to make a new high that would finish off this count here, which is 1, 2, and then a subdivided 1, 2, 3, 4, 5 for a 3, the 4, and then that would seem to be a 5. If that turns out that way, this will probably be a daily divergent signal. And so having a fifth wave count into resistance and trend lines with a divergence, hopefully would be enough to get a correction. And my target would probably be somewhere around this 2900 area. I mean, we're late enough in the game where any top can be the top, but short of that being the situation, this would probably be a target area. Now, I was going to show you something else. Let me show you my weekly chart, and that's not it. But this is. The 2 is just a numerical. I have, monthly is 1, weekly is 2. That's the significance of the number. But what you have here is kind of interesting. Now, here is a divergent sell signal as of Friday last week on a weekly chart. You've got to you've got to wait till the end of the week for it to be valid. And as you see, my indicator here, if you eliminate this line, this indicator here, this bar here is lower than this one, and you've got a higher high in price. And so bingo, all of a sudden you've got a weekly divergent sell signal as of last Friday. It was confirmed with the stochastic down here and a few other things. I thought, boy, that's a pretty big deal. Usually you get a daily divergence before you get a weekly. Now, what this bar is saying right here, and if we, this bar you can see is higher than last week's bar. What that would do would be to invalidate it. In other words, if this were Friday at the close right now, this signal would be invalidated. So, you got to go back to the drawing board. What could happen is, since this week is still live, if we happen to make a top, let's say today or tomorrow, or even Friday early, it would probably have to be early Friday for that matter. But if we happen to make a top, if we happen to make this fifth wave, higher high, and we got a divergence and so forth, and then it started to sell off pretty good, conceivably, this yellow bar here could shrink before the close and get down below this bar of last week. And now you've got a weekly divergent self signal last week that's confirmed, and you get a daily this week. And that, that and, God's good graces would get you the correction that I'm kind of looking for.
How big a correction are you looking for?
Probably 2,900, somewhere around there. I mean, ideally, it could even go a little bit lower than that. Mm-hmm. But my bigger date comes up late next month, and that's kind of what I'm looking for. I haven't had one of those dates in my work come up for a long time. I mean, literally July 19th. Well, that's not right. October, the last date was October, the second week of October in 2007. But the date before that was July 19th, which happened to be right on the money. That was the orthodox high. We made that, well, I'll show you. I mean, I know you remember, but let's see, where are we? Here you go. In 2007, this high here, oh, this is the weekly chart. Well, anyway, the high was obviously this week, the week of July 20th. The day happened to be July 19th.
Right.
So there it is. Then you get a pretty good correction into the August low, and then you get the rally back up into to that high. Oh boy! If you give me just one
you
second.
need to grab that? Go ahead. Hey, John, your mic's open. Are you there?
Hi, yeah. Actually, I just want to come in and say hello, but also just a remark of what you said about having a high next month, late next month. That makes sense because it's a little bit like 87. Remember, we're on a kind of an 87 repeat timeline. We're running about a month behind, so that high could come in late September, or it could come, I think if we're sort of shooting for the moon, if we're up to 30, 31, 32, 33, sorry, 3100, 203 on the S&P, and a kind of a blow off, if we get to the August 24th, some of the old timers might be saying that's enough for me. That's as far as we got in 87. I'm getting out here, so that could kind of hobble the market from going higher into September. But but I do believe. I mean, I think that the chart that we're looking at, the up-to-date part of it right up to the moment, looks incredibly bullish, and that the sort of a double 1-2 spike could be, we could be going into the third wave of some sort of a fifth wave here, based on the the incredible spikes and the way the market keeps recovering from these spikes. And so if we get a half a point rate, if we get a couple of half points or quarter points, or a combination of two of the, maybe up to a point in rate cuts over the next few months, that could help the market a lot. Now, there's a little bit of a risk in that as well, because just the fact that the Fed is seeing it necessary to lower rates, there's two sides of the coin. Number one, like we were talking yesterday or the day before, how much more potential has the U.S. economy got to grow if rates were lower? Could we add half a point or even a point in growth or even more? And that could still, be the fuel that powers the market a lot higher still. So on the other hand, if the market perceives that the Fed lowering rates is a sign of weakness in the economy, the market could turn down, especially if the earnings don't come in as well as expected, and also if the growth doesn't come in as well either. So some people may see slowing growth as a more bullish omen for the future. Every time the market gets weak, the economy gets weak, the market seems to like that, because it negates the potential to raise rates. But I might just share some of my ideas. In a lot of ways, we could be looking at a 1998 situation here, where the market had a correction like the ones we've had, basically the one last year, and the lesser correction that we had in June. Remember, it was only a month-long correction in May, and we've certainly recovered that all of that and more in June and July, and going into July. If the lowering of rates, remember, we were stimulating the economies everywhere in the world: Europe, Asia, China, Japan, UK, Canada, Australia, and now the US. normally that leads to higher growth eventually and higher stock markets, and so the stage is set. And look, generally speaking, when you run into a big end of a decade number, just like 2000, 2010, 2020, you're going to have a big rebound. It could be rallying into 2020 in a pretty big way, and the Fed may get behind the curve because of this, and especially if the dollar breaks a lot, 10% or more, inflation could show up, and that could cause the Fed to actually start raising rates sometime in 2020 or 2021, and ultimately that could be that could cause some problems that are sort of unforeseen consequences of being too dovish, if you like, right?
Gotcha.
So, and the risk of that is that it's sort of like the 1979 syndrome. How did rates go from 1% to 21% in a year that caused gold to skyrocket? But at the end of the day, it didn't really affect the economy that much. I mean, we did end up in a bit of a recession in 81, 82. But as I point out to people, you won't hear this from anybody, because nobody was paying attention to the NASDAQ back in 1980, because it really was only in its embryonic stage. But the NASDAQ went up 40% from November 78 through February 1980. While gold went up fourfold. So gold going up fourfold is not the end of the world, and the markets could go up just as dramatically in the next couple of years going into this 2020 period. But what's likely to happen is interest rates could also rise dramatically, and that creates a problem that is an unforeseen consequence of these actions. Just like Winston Churchill said, we shape our houses and they shape up. If we overstimulate it, which we have, what are the consequences? Are we seeing the consequences of all this 30 trillion in stimulus, ongoing stimulus before our eyes now with the sudden rise of gold? And this is the beginning of what could be a 4-year run to the upside, as well as a 4-year continuation of the dollar down cycle.
Right.
And ultimately, the more the dollar goes down, if you don't believe me that everybody thinks that the dollar going down is going to be lower interest rates, that's exactly not the point.
Speaking of interest rates, Garrett, what do you think is going to happen next Wednesday? Are we going to get a half a point, quarter point, no point?
Hang on just 1 second. Okay.
What are your thoughts, Mark? Do you think it's going to be a half?
I have no idea in the world. I think it would be.
That's a great answer.
I have absolutely no idea, not a clue.
So you can't be on CNBC because you tell the truth. You don't know, but you got to be able to look the audience in the eye and with great. Go ahead.
Sometimes I don't know is the smartest answer you can get. There's a lot of people who like to gain attention for mental acuity by giving a bunch of answers on things where the proper answer is I have no idea. Too bad we don't hear that anymore. I think it would be ridiculous to do that at this time, and the reason I say that is, what are we? Are we in a bull or a bear market? Well, we're in arguably the longest bull market in history, and I don't think it is. I think your longest bull market in history, not that it makes any difference, went from 1982 that John was talking about there. By the way, that was one heck of a recession, by the way. It's the last time that the news media openly and frequently talked about depression.
Right.
And it was.
And remember, look, raising the rates to 21%. Remember, the bonds rose to 16% or something. So it really, hobbled the economy. But it on the other hand, it gave rise to a bull market that's still going on effectively since then. So I think I totally concur with you. And what we got to be careful of, we're getting into the late stages where we could have a blow off. And what I'm trying to get to the point is this: right now, before we earn a single dime from taxes and revenues and all that kind of thing, we have to pay about 328 billion a year on the debt, the 22.5 trillion in debt. The debt is, if you look at the debt and gold, they're basically going up in tandem over the years. And right now, gold is behind the curve basis the debt. I think everybody would agree with that. When the last time gold went up dramatically was in 2016 off that low. We went up 30, with the biggest move up in 30 years in gold stocks. And that was when the debt went through 19 trillion. Okay. Somehow when we went through 20, it didn't kind of phase anybody because for some reason 19 trillion was a trigger. I believe the new trigger is 22 trillion, 22 and a third, half or so. This deal they just did to get the debt ceiling raised is going to add another $500 billion. So we're really, we're going to be 23 trillion within a matter of months.
Well, they said it might be 1.7 trillion in reality. And if you look at things that, I have no idea what it's going to be, but it's probably going to be something like that. And the concern I have, you can't go back and do any, you can't all of a sudden get economically conservative and wise after you've blown the thing for decades.
Right.
Unfortunately, you've got to play your hand out until ruination.
Right, and that's the thing. That's what's coming. That's the juggernaut that's coming that everybody's sweeping under the table right now. And here's the problem. And this is what could send gold 8,750, or could send gold fourfold, eightfold from here. They could be sowing the seeds of this destruction today. That's going to hit us in 3 or 4 years' time, because the debt, we get to 23, 24, 25 trillion, and then interest rates rise. The debt, it's already going to be twice. It's going to be like 700 billion. And suddenly the debt goes up. The next thing you know, we're paying $1 trillion. We could even spike to 2 trillion. If we spike to 2 trillion, the government has, its revenues are going to be cut by 2/3. It's only going to have $1 trillion in revs, in actual spending revs. So the situation could really get out of control, not just in the U.S., but in China and most of the Europe, in most of the Western economies, which is what I've been talking about for a long time. And I've made the analogy with, in the 1920s, the Weimar Republic was the poster child of inflation. We remember we went from 10% to 100% to 1,000% to 1,000,000% in 4 years, and ultimately the same fate could befall the Western economies because of this out of control spending that's been going on for years. So that's the scenario. You have great economic times and you have bad times, and bad times are the fallout from the good times. And those.
Well, I was going to say, I think you're going to have a mishap before we have the luxury of being able to get there. There's too many things that are close to falling apart, and you don't have, when you do what they're doing now, and there's not much else you can do. You don't have any ammo for when things turn around. When things turn around and get bad, you can already see to some point we're pushing on a string right now. And in this chart, I brought up this page here. This says, is accommodative Fed bullish for the stock market? Quite the contrary. Here's where rates dropped 51%, and you're in the sell-off after 2000. In 2006, you had rates decline again, and the market declining pretty close to 60% through that decline of rates. And now you've got, rates running up here like this, and we're going to start the rate decline, and ironically, we might start I think we're going to have an accident relatively soon. I don't like to try to guess those times, but I do have some stuff. Like I say, I have a date coming up in my work that hasn't happened for 12 years.
Did you say an accident, Garrett?
Yeah, I think we're going to have something that's where we're probably going to get. John mentioned 1998, and I think I'm actually looking for a 98 type of situation where you get a pretty good washout, and then you get one final move. And for me, my target is 2020 and early in the year. We'll see, but I think we're going to get something that happens this year. I mean, look at Deutsche Bank. I mean, they've laid off, I think 20,000 people so far, and maybe more. Laid them off. I think they fired them. And this Deutsche Bank was, a huge derivatives bank, and I mean, the one way to solve this problem is in the Fed and basically say to all those criminals who have been doing the world central bank situation. And I mean, hey, Dwayne, you think you could make any money if you ran all the central banks of the world and, you knew when things were going to happen? So, when stocks, bonds, currencies, gold, oil and gas, everything else, when that's going to happen. And somehow you put people in a position to control that aren't part of any government or anything else. And we're focusing on everything else because they control the news media. They take our focus away and have us put our concentration on foolish political games when that's the problem. I mean, if you wanted to solve this problem real quickly, of course, you need a pretty good army or two on your side, but you just go to the central banks and say, oh, by the way, all that debt, the world debt, sorry, we don't. Who do you owe it to? You owe it to the central banks, right? They're the ones creating money out of thin air and pushing it out there. And basically you say, hey, I'll tell you the debt we're going to fault on, the debt to you criminals. But I don't know. I mean, are we going to be enlightened enough to do that? I don't know. But I do think we've got something coming up I would say in the near term where we get maybe a 1998 type of event. And then we get, one more good, really exciting move to the upside. And I would think that would be generated. The reason I don't want to see a 0.5% move here is because I think it's the wrong timing. In other words, why in the world would you need, if you just look at the stock market alone, why would we need to cut interest rates at 0.5% when we're making new highs in the market?
It is kind of hard to justify.
Well, yeah, Garrett, look, your little chart there to the left that we're all looking at tells the story. We're looking at a variation on two previous themes where the Fed actually, okay, look at the 2006, that top there, and look at where they started lowering rates. I mean, if they start doing that right now, is it going to be a self-fulfilling prophecy where the markets look at the way the market broke when they started lowering rates? Look at the previous time in 2000. So this is a really risky, while there might be 10% upside in the market from here, which I think is reasonable, but boy, there might be a lot more downside once we get that 10% under our belt. And I do agree with you. It's hard to say whether we're going to have a blow off here in the next few months, or a couple of months, or month, and then we have a correction. And then there's one more, blow off in 2020 possibly, and after that, we're at the mercy of whatever happens in the future. But there could be some bullish things. For example, if they get, we're either going to get a stimulus package, not the stimulus, infrastructure package, possibly before, it's hard to say whether there'll be one before this next election. If there is, that could give the whole economy and the market a shot in the arm. If Trump wins, I think that you can guarantee there's going to be an infrastructure bill in the next era, in the next cycle. So there's that supporting stuff for the economy and the market. But it's not that weird that the thing that hasn't happened yet is the market hasn't turned down in order to motivate the Fed to really start the economic telltale signs. The cracks are appearing in the dam, but they're not enough to cause the market to turn down just yet meaningfully, or cause the Fed to be much more aggressive cutting rates. But they're obviously got reasons to cut rates going forward. They said so themselves, and and the thing is that the numbers could turn negative pretty fast.
I think they're going to have endless reasons to cut rates pretty soon, because you're starting to get a stagflation thing going on here, and the problem is the problem with inflation. I mean, if you have monetary inflation and they try to do that game, like I say, I think we're going to see a surprise. Fortunately, it appears I can never tell anymore whether anybody's honorable or if it's just different factions of the string pullers out there, pulling our attention from one direction to the other to continue the game. I mean, the game's has been going on, forever. So to assume that it's going to end somehow is crazy. And yet we're in the window now where, I mean, even on a spiritual level, apart from all this, something should happen. So, but I do think we're going to get. It's interesting that you mentioned 1998, because I think we can get that kind of a surprise, and I think it's coming up in the next. I really think in the next month or two, you're going to see that. And the reason I'd like to see interest rates not do anything at the moment is because, first of all, number one, let's say they drop them 0.5%. You really think that's going to help anything? I mean,
it could be the kiss of death for the market.
Yeah, I mean, I think it's ridiculous. What I'd like to see is them not do anything. And what would their comment be? I mean, if I was making a comment, I'd say, hey, when the market's at new highs, the economy is doing fine. There's no reason in the world to do anything. We're not going to raise rates, but there's no reason to drop them at this point in time. And I'd say that because if we got a little surprised, it's triggered by a fallout from, Deutsche Bank or whatever. That's one of many areas that could trigger it. And we're right, and we do get a 1998 type of event where you get a 8, 10, 20% or a test of the December lows type of correction that really puts a scare in people. What I would expect then is for them to come out and say, particularly if it engineered some selling, because now you've got a completely different market. It's not the typical, well, it's always the psychology, but the difference that you have, of course, now is the ETF situation. Number one, where people aren't buying stock per se. For the most part, they're buying ETFs in one form or another. And secondly, you've got the algorithms. So algorithms, are they affected by human nature? Well, ultimately, everything is to one degree or another, but sentiment is not like it used to be. It's different. And mainly because machines, don't tend to have the same emotions that humans do. But sooner or later, the rubber meets the road. And if you were to engineer and get some selling going on, maybe the algorithms are starting to get set up in to such a degree that not everything is bullish. And if you got a strong sell-off that people started to jump on, which I think could happen, maybe then you have a move such as John was saying, where they come out with another QE number one, backed by not dropping rates this time, but maybe dropping rates maybe as much as 1% out of the blue. at that time, and then you get everybody in a major reversal. You get what I would think would be the final rally to wherever it goes. My assumption would be if that could happen with the decline in the September-October period, then you get a run into probably January that's a sizzler, and then you hit the road and try to find. I mean, in other words, the market's the only place to go that's safe. You know, what happens when you need to get out of, that's the worst argument in the world, to be a bull. Well, gee, there's nowhere else to go. I'm going, well, that's great, and that's going to work like a charm until it doesn't. And when it stops working, you've got a serious problem. You got a problem that we'll never see. This will be a once in a lifetime situation when it happens. And the problem is throughout our entire lives, John, all of us, the three of us, we've always had a safe money place to go. It was always U.S. Treasury bills or money market funds. And say, hey, I don't like the market. Well, fine, I'm going to get out. I don't care. I'm getting out. I'll wait till I do like it. Can't do that anymore. Where do you put your money now that's safe? Oh, we'll put it in gold. You got to be kidding. I mean, I'm one of the original gold bugs in the country. I think I can make that comment. You got to be kidding. Is it a safe place? Is there a place for safe money in gold? Sure, there is. But what happens when it's run another, quite a bit up? And all of a sudden you got a deflation, because I think that's what you're going to get. Where do you go? And but that's a rhetorical question. The problem is, for the first time in our lives, we don't have that. It's like when you're a kid playing tag, you're on home base. You got your hand on the tree, and you're safe. There's no trees. There's no home base anymore, in that hide and seek game. And that's the scary part. Literally, where do you put your safe money? Right now, gold is, vis-a-vis cheap, and silver may be vis-a-vis cheaper. But you wind up, if you put your money in there, you wind up putting your money into a ruler. In other words, you want this, this basis of exchange and safety, and you've got yourself an elastic yardstick, rubber. You got a rubber yardstick that can go all over the place, and you don't have. In the old days, remember the term, John? The dollar, it's as good as gold. And for a while it was. So, but now. You've got that's the hard part. That's one of many hard parts, I think, and we're going to have. This is going to be unfortunate, because bear markets have been nasty in the past, but certainly livable, and most of them have recovered 100% of their decline relatively quickly. The 73.4 bear market didn't. In the 81-82 bear market, in my view, was merely a continuation of 73 and 74, but then you broke out in early 83 and never looked back, and we've never looked back since. Bear markets have been relatively easy. I mean, that 60%er on the page there right now, this 60%er right here, that was horrible, but here you are. You've recovered the whole darn thing, and now you've got that much and more up here. So nobody, first of all, you've got a whole group of people who have never seen a bear market. Lots of people in this bull market have never seen a bear market. And then you've got the human memory, which, doesn't last very long. And you've got 10 years of a bull market for those people who have seen bear markets. So you've got people who've never seen them, number one, and you've got a group of people that are just typical human nature, where probably 90% of the rest of us figure, hey, this market's going up forever. And that's a nasty combination. I better run. I'm so nice. It's always nice for me to get a chance to talk to you guys and learn your thoughts. So anyway,
likewise with you, Garrett.
Yeah,
Sure.
you guys have a great day. Thanks for
Thanks,
for
Garrett.
letting me come on. Yeah, thank you for letting me come on your show. I've been a stranger.
You have.
I got I had a bunch of stuff going on. My daughter's back in college, and that it's nice to see her again. And I got pressed into a trip to Hawaii. Everybody, for some unknown reason, said I needed it, so I went kicking and screaming off to
Yeah, they
Hawaii.
try to tell me that stuff too, but I don't pay them no attention.
Yeah, I'm not smart enough to do that, but I got outnumbered and overwhelmed, and I went kicking and screaming to Hawaii and wound up somehow enjoying myself. So I'm back at the grind now. So anyway, thank you so much, Dwayne. Appreciate it, John. Always a pleasure to share thoughts with you.
Likewise. Thanks very much. Great work on your behalf. Thank you.
Garrett, we'll
thank
see you next Wednesday.
Okay.
Call me
Thanks,
before
Dwayne.
then. We'll dream about extra.
Yeah, I will.
All right.
Oh yeah. Okay. Oh, good. Yeah. Okay. Okay.
Take
Bye-bye.
care. All right, John. Any charts you want me to bring up? Anything you want to look
Yeah,
at?
I think chart of the day is platinum right now.
Okay.
And
Fetch it.
if you remember yesterday, we were very bullish on platinum. Have been the last few days. And it's starting to look more and more like the bottom is in. And not only that, but it looks like we're going to explode to the upside on platinum. It's going to be increasing upside from here, possibly accelerating upside.
All right. Let me just get these charts opened up. Okay, now that's set on a daily. Look at that gap.
Yeah, it's big deal. Yeah,
Huh.
yeah. It's really. It looks like it's gonna. It really moves dramatically higher out of there. The silver is up again.
Hey, I'm looking
today.
at this daily chart. I don't see any other gaps on this chart of that magnitude.
Yeah, exactly. No, it's
there's a little
gigantic.
one right here.
And that gap tells a story in of itself, because look at the way it tested. I mean, certainly was a very difficult chart to get long in the way that it's getting long, because it almost looks like a wedge correction was going to break down. It's done the opposite.
Mm-hmm.
And if you squeeze it up a bit more, and the way it's coming off this base, it really does look. You can see how and look at the previous history. The February rally, the April rally. You've had some very strong vertical rallies, and I think that's what's about to unfold for platinum. And I think that will lift the gold. As a matter of fact, the gold is turning right now.
What's the typical relationship between platinum and gold? Are they move in tandem?
Well, platinum tends to go twice what gold. If platinum's up 20, which it is right now, it should mean the gold's up 10. So we've got some catching up to do today. And basis silver, gold is lagging as well. We're up to 16 on silver, and I think we're at a new multi-month high today on the silver.
Silver.
Just about.
Yeah. Let me put this on. Put on monthly.
Yeah.
Okay.
I mean, the silver looks unbelievably bullish. It just really is.
It's a monthly chart right there.
It looks explosively bullish, the silver, and so I think the platinum, the white metals, the silver and palladium are all set to soar, and it certainly looks like one way or another the gold's heading for about 1700 within possibly by September. So and I think the gold will accelerate higher. It's been banging on the door of 40 and 30 for a few week or two right now, and I think once it breaks 40 and 30, we're going to be testing 14, 50 and 60 again. And if we start exceeding those levels, I think we're going to run to 1500 pretty quick. Probably 1550. We should go up at least $100 to about 1550 from a breakout above 1450. The British pound, which I said to keep an eye on, kind of made a lower low yesterday and just before Boris got elected, and it's up today, which I think is a good thing. and it could be leading the European currencies. Maybe, I think if the pound starts breaking above 25.50, 125.50, could see it reverse. It's not. You see how potentially dynamic that pound looks. If it were to suddenly run up to 26,
we got a slightly higher low here. So
exactly.
Yeah, that could certainly be the beginning of something big.
Cup and handle type deal. And that should lift the rest of the currencies and should send the dollar down. So, obviously we're counting down the days to the Fed move. So the markets appear to be kind of positioning themselves for the next move here. And the metals are accelerating higher as we speak here right now. So it definitely looks very, very positive. Another thing today was just amazing. I mean, remember how not so long ago we were talking about how the SOX SOXL got crushed down to it got up to about 200, and then it came all the way back down to jeepers, 110 or something. Look at that.
Yeah,
I mean, look at the rebound. I mean, this is just hyper bullish, and the fact that the semiconductors are leading this strongly is very, 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 very bullish, frankly. So, look, these stocks like Xilinx and Keys, and remember what I said about Intel? I mean, Intel is just, I think Intel's going to go to new all-time highs. And Apple's obviously doing okay as well. Not too bad, being a semiconductor. But there's some other semiconductors that are breaking out big time. My favorite, Maxim, looks very, very bullish. I said a while ago there wasn't much risk in being long Maxim, and there could be a takeover of that stock. So
MAXM?
Sorry, MXIM. MXIM.
MXIM. There we go.
Yeah.
Okay. Wow.
Yeah, it's streaking higher right now. Yeah, and if you can squeeze it up, you'll see that it's actually. I was thinking this stock's headed for about 90, by the looks of it. And if it goes over 100, forget about it. See that previous spike? It's once you start going up against the previous spike like that, it's sort of begging to kind of test it and maybe overtake it. And when you look at the even longer picture, look how bullish that is now. I mean, it just looks incredibly bullish, the way this stock's been behaving. I think it's probably, look, this would be a pretty good fit for Google or somebody like that to come in and buy this thing, because there's a lot of things that Maxim's doing that would probably complement Google's technology. And it could be Tesla, because anything, they're doing a lot of stuff for cars. So what a tragedy about that guy.
This guy. Oh, yeah, I hadn't heard about that.
Yeah, he got hit by a Puerto Rican, I think, and in a boxing match, and he unfortunately died. Which is a real tragedy, but anyway.
Doesn't happen very often, but
no.
But everyone that climbs in the ring understands that it can.
Yeah.
So this is that Maxim company, Maxim Integrated, that you were just talking about.
Yeah, they're doing a lot of stuff. You see, I mean, LEDs and things. I mean, this company's in some great technologies that are. And I think they're gradually building their business with a lot of car makers, and I think a lot of stuff going on.
Biosensor Solution and Raku smartphone. Interesting. Okay, what else?
Well, just another note on the metals. The platinum just made a new high on the day. And I think we're in a mode today where just as I was saying, the gold could catch up with the platinum, possibly be up $5 or $10 before the end of the day. When it starts rallying in the afternoon like it's doing, it's usually very bullish. The gold stocks, once again, are rebounding. There was a great chance to buy a roll of gold this morning down at 117. It's now 118. so the gold stocks are pushing higher as well. And you look at that Royal Gold, you know, it's very spectacular. You know, it's Wednesday today. If we have
I've seen a $38 move over since May 6th.
Yeah, it's unbelievable. By the way, I put out a buy recommendation of $24.50 on that stock back in 16.
Good job.
So, thanks. The silver, the USLV is going higher. That's probably going over 100 before you know it. If tomorrow's strong, or we're overnight strong in the metals, going into Friday, we could have a very strong finish on Friday. So we could have a very big week. And then we've only got a few days into the end of the month. So it's going to be a very big month for the metals, almost for sure. And
now this USLV is up against pretty good resistance here. Got a previous double top right in this area.
Exactly.
If we can close above that and hold it on a pullback, then
it's a really, you know, once this thing starts going over 100, it's a whole new ball game. So the grains, incidentally, are moving higher. You know, I listened to the agricultural show. Had a pretty smart guy on over the weekend, and he was pretty what's the word? Cautious on the upside for the agricultural products. He thinks that we're going to have a problem in August, and you know, sometimes you get flood. You know, you might have a bit of a drought that causes some upside in the grains here because of the hot weather, but sometimes the rains come in August can smash the grains down. So he was thinking that may happen. So just something to keep in mind. But the other factors affecting the grains, such as the floods that we've already had, delaying the plantings and acreage, etc., reduction could actually be bullish. So I'm not particularly, you know, I'm listening to the commentators, but I wouldn't necessarily take everything they're saying as gospel, because sometimes these guys get monumentally wrong when you're in an emerging bull market like this. You know, they've kind of been, you know, things can change. Just kind of like the sugar situation. You know, how that could suddenly become a very bullish market if we get a hurricane, you know, several hurricanes coming through the Caribbean, things like that.
Speaking of hurricanes, we had our first taste of monsoon activity. Oh, I think I told you.
Yeah.
Not last night, but the night before. It's just a taste of things to come. You get a lot of rain, but shred a lot of wind. And some rain. It's overcast today, so.
Yeah, the stock market, well, is actually, you know, especially with the I got to take this.
Okay, go ahead, John. Take care.
The stock market looks ready to go. It's looking very bullish. So.
All right, catch you tomorrow. All right, guys, here we are. Back to the S&P. All right, beginning of the show, radio freebie, consider being long 3010 to 3012. Trail if possible. All right, so we got 3012.75. Previous swing high was 3012.75. That qualifies as a double top based upon my understanding of what a double top is. Now, we said once we did that, we would look for a pullback to the BBC, because price always reverts to the mean. I'm not saying this thing couldn't just take off, sprout wings, and run up to the zone overhead. Well, not saying that. I'm just saying, and I'll show you. We got a little leg here, leg, resistance, retrace, leg, got through resistance, retrace, pulled right back to the CFMA1, which is blue and climbing, another leg. See, now we're, so in the 1230 candle, we tagged it, 1230 to 1, tagged it again, and now we're still pressing up against it. Now, of course, the question that I get a lot is, okay, in a situation like this, the more it tries, does that mean it'll eventually break through? Or with each attempt and failure to break through, does that strengthen the resistance? Take your pick. You can have either one, because it'll play out one way sometimes and it'll play out the other way at other times. So I cannot tell you with high probability which is going to happen here. I do believe, okay, now I can't speak to that, but what I can speak to is the fact that price always reverts to the mean. As we continue to go sideways, okay, which is what we're doing, the BBC will. So price doesn't have to pull all the way back to 3006. If we were going to get a pullback right here, right now, it would have to come back to 3006. But as we move sideways, this is going to drift higher. Okay. Now, let me point out, if this thing were to just insist upon going sideways into the close, into the open tonight on Globex, and this continues to rise, okay, a pullback to the BBC is one thing, but when the BBC rises to meet price, not the same thing. A pullback here, if all of a sudden the bottom just fell out and this thing dropped to 3006, I got to say it would be an extremely high probability that price, once it hits the BBC, will go back up to challenge this area yet again. Okay, but if we just roll sideways and this drifts up to meet it, there's a high probability when they do touch that the BBC won't hold. Completely different dynamic. A pullback to the BBC and BBC rising to meet price does not give you the same high probability opportunity. In fact, almost the opposite. So if it is going to pull back, I'd love to see it happen now, and then we might have, a good opportunity as we run into the close. Okay? All right. So we looked at that one. Looked at the Dow. The Russell. Last night's Russell leading to the upside. Now remember, Russell is 2,000 small cap companies, whereas the S&P 500 is 500 large cap companies. And the Dow 30 are 30 large caps, but they're also considered to be blue chip. In other words, the creme de la creme. Okay, last night on the Russell, consider being long at 1563. It's going to be right here at one of last week's weekly zones. Let's see what this week is looking like. This week, the zone is at 61/62. 61/62. And above that, we got 70/71. Some weak zones will be very close together in regards to the previous week, and other times it seems like miles apart. So we got 61/62, 70/71, and then the highest weekly trading zone for this week on the Russell, to use a technical term, it's way the heck up there. 1600/1601. Concierge Trade Alert from last night said consider being long 1653. Remember, only three things can happen when price encounters a weekly trading zone. The most likely thing to happen is consolidation, which is what we're looking at right here. Second most likely is rejection. I don't really have rejection on this chart. I'll show it to you, point it out next time we encounter it. And then we have a slice. And remember, when we slice through a zone like it's not even there, what do we expect the market to do? In this case, in an up move, we expect it to pull back to the zone, confirm that it is now going to be good support, as opposed to on the way up, we expect it to be good resistance till it isn't. So we're expecting good resistance. We don't get it. We get the slice. Price pulls back, confirms that what we thought might be good resistance is now good support. And then it continues in the direction of the slice, looking for the zone overhead. And that's quite a zone. That's 30 points at $50 per point. Could it happen? Today's only Wednesday. A lot can happen over a couple trading days. We still have the remainder of today. We got Thursday, Friday. Swing high so far is 1575.20. So from 53 to 75, that's 12 points at $50 per point. So this is a $600 per contract move so far. $600 per contract. Those who've earned the right to trade 10 contracts, as an example, this is a $6,000 move. That's a function of math. Has nothing to do with our methodology, our strategy, our indicators. Okay. Now, our methodology, our strategy, and our indicators have everything to do with us issuing an alert to consider being long at 1653 and everything that's happened since. But the difference between one contract and 10 contracts, that is purely a function of math. Okay. Now, let's look at the NQ. Again, these are last week's zones we're looking at here for the moment. Zone overhead is at 80.32/33. I'll get it in the neighborhood. There. 30.32. Below that, 79.35/36. Okay. Still plenty of room to run on the upside. Last night's Concierge Trade Alert, instead of being long 79.90, which is right here. And the swing high was only 95. So we punch through the trigger, get a retracement, hit the trigger again, retracement. Now, you may have heard me say that the second and third trigger often represents less risk and higher profit potential. And that bears out beautifully here. Okay. If you know anything about market structure, you understand where your stop loss needs to be here and here for this trigger and now for this one. And if you don't understand that, you really should take the trial. Spend 5 days with us in the live training room. Spend some time with me in a one-on-one mentoring session, and I will give you an idea just how important market structure really is when you're assessing the market, doing your analysis, and creating your narrative. Okay. Now, if we put our indicators back on, bullish cross, very much like the S&P, bullish cross. We haven't had that pullback yet here. Since the bullish cross, we've had no pullback to BBC. So it might be very tempting for someone to just, get long here, right? Someone that doesn't see the market through our lens, because they don't have our lens, which you can have for 5 days free, no credit card required. Before I get long here, I would like to see that pullback to the BBC, or at least an attempt at a pullback. Okay? Not to say that the market just couldn't just take off and run 30 points to hit that zone overhead. It could. I don't think it will, but what I think, take that with a grain of salt. Watch the market, and it will show you. It will tell you. Crude. Not a lot of movement. Well, no, that's not true. From this weekly zone from last week to this weekly zone right here, that's $1,000 per contract move right there. $1,000 per contract. Okay? So we had a leg, a retracement, and a leg. Now, this week's zone is down at 55.80. / 85. So you can see what the market was trying to do there, right? It was trying to get to the zone below. And it still well may. Not saying this moves over. Now 55.80 / 85. Zone overhead, 56.60. / 65. Okay. And then the zone above that, 57.30. / 35. Okay, so these are this week's zones. Price went up, hit the zone. Now that wick sticking up above, that's a real telltale signal that this, in fact, is pretty good resistance. Right? We consolidated there. These are 30-minute candles. It sent us back down to the zone below. So from 57.30 to 56.65. So $600, $700 per contract move. We then consolidate at the zone, and then price decides it's heading to the zone below. Okay? Still attempting that. Last night on the Concierge, consider being short at or below 56.45. So it's going to be right there. 56.45. Here we go, 56.45. So the first move down took us to 56.28. This move so far is taking us down to 55.93. Bearish cross right there. Bearish cross, Good resistance. We sliced through the zone here, and it doesn't carry quite as much weight because we already moved through it here. Okay, this was the initial slice. Remember that during the life of this candle, it was a big red candle all the way down to here, right? But before the 30 minutes were up, it moved back up to here. So is that a slice and then price pulling back up to the zone? It is. And then we spiked it up to the BBC, which we expect to be good resistance until it isn't. And there's the rest of the story, as Paul Harvey would say. And last on the agenda, gold. Our old friend, sideways gold. Yeah, not a lot to say about it. Concierge said to consider being along 1423, which would be right about there. All right, 1423, and we put in a swing high up at 30. So that's a $700 per contract move. Important prices, important areas, almost always tested. Price gets back below the trigger and looks like it's ready to run once again. Now, zones for this week, 34.35 is correct. And then below that, we've got 15.16. So we took that out and that out. I'll tighten it up later. So 15.16, we won't worry about the rest of them for now. Price came down to the zone, a leg and a retracement, a leg and a retracement. Looks to me like the market's trying to do, get to that zone overhead. We'll let it roll sideways, and once it shows life, just lay our indicators on. We just had a little bearish cross. Question is this a head fake or not? Okay, we had a bullish cross, a leg and a retracement. But watch this very carefully, and as price goes back above the BBC, I would certainly look to be long this market, 1426 to 1429. Double radio freebie. CFRN, the station that pays you to listen. All right. So there you have it. In a nutshell, whatever that means. Why do we put things in nutshells? I don't know. All right. If you want to participate in the next Logic 247 trial, get a hold of Valerie, let her know. Support@cfrn.net. Support@cfrn.net. Or give her a phone call. 949-42-EMINI. 949-42-EMINI. And just say, hey, Dwayne was talking about the next Logic 247 trial. I want to be a part of that. Seating is limited. I like to keep it to a number of people that I can effectively work with, help, mentor, coach, show, explain. I don't know if we're going to start tomorrow or Sunday night. Your responses might determine. In fact, well, let's not in fact. Let's just leave it at that. If you want to be a part, get a hold of Valerie. Let her know. She'll put you on the list, and that'll guarantee you a seat. Whether it starts tonight for Thursday, Friday, or whether it starts Sunday night for Sunday, Monday, Tuesday, you'll be on the list. All right. Let's go to our good word for the day. Let's see, is there anything in the chat box? Oh, Richard, I'm sorry I didn't see your comment earlier. Tim, you're looking for the platinum symbol. Hang on, I'll get that for you. Richard had commented while I guess Garrett and John were talking. The debt bubble, when it bursts, will be deflationary. Everything will go down, including gold. I believe the zero interest rate policy only postponed the deflationary K wave, which is yet to be fulfilled. The bull market is not over yet, but is in the late innings. Once completed, watch out below. Thank you for that, Richard, and I concur. I think you nailed it right there. So, Tim, platinum. Looks like GPLN 19. Oh, before I take this chart down, on the Concierge last night for soybeans, consider being long 913. That's an important price, important area. It's a line in the sand. See how price marched up to it, backed off, marched up to it, backed off. Now the other line in the sand is way down here at 898. Okay. Once you draw your two lines in the sand, everything in the middle, everything between your two lines in the sand, is the market trying to make up its mind what it's going to do, which way it's going to go. Okay. So we take no action, for the most part, between the lines. There may be times when it becomes evident what the market's trying to do, and so with the dynamic real-time alerts, Logic 247, we very well could have an alert that takes us up to the Concierge trigger. Typically, those two will work hand in hand in concert. And when you take those two things, the static report, the dynamic alert, and then the weekly trading zones, layer those on, and then slap our indicators on top, paints a very crystal clear picture. It's not a confusing picture. It's not a bunch of spaghetti on the screen. Once you understand what each one of those, and that's it. You're just waiting for me to go, oh, and then we put this on it, and then we add this. No, I'm done. Concierge, lines in the sand, dynamic real-time alert, 24/7, our indicators in the weekly trading zone, that's it. When you put those four things on your chart, it gives you a real clear picture of what the market is attempting to do. And that's as good as it gets. That's as close as you get. A high probability move simply means there's a greater probability of one thing happening over another. You're never going to get any closer than that. We spend time, we spend treasure, we Google till our fingers bleed, looking for that one more thing, that one more filter, that just what, boy, I'm literally mouse clicks away from greatness if I can just find that one more thing. Well, when you find it or think you found it and you put it to work, it might serve you well for a day or two, but eventually you're going to find, you're like a junkie. You're going to need another fix. Okay, all right, now I just need, okay, all right, whoa, I'm like one mouse click away from greatness now. And so you layer in another thing. And it may serve you well for that session or for that week, but then pretty soon, gotta have another fix. One more thing. It is a diabolical, endless circle, loop. It's not good for man or beast. At some point, you have to just say, stop the madness. I'm chasing something that doesn't even exist. Let me take what I have right here, right now in front of me. Let me take what I do know about markets right now. And it doesn't have to be a lot. But whatever it is you have has to be grounded in truth. It has to be in that category, truth about markets. We talked about that other thing this morning. They can run my stops. Okay, that's not a truth. That's fiction. It is a market. It's an urban myth, urban legend. Now, I'm talking about futures. I'm talking about indices. When you're trading stocks, especially if you have a low float stock, a stock that doesn't trade a lot of volume, okay, there's a market maker in there. You see, futures is an honest market because there's no market maker. Sorry, market makers. There's no guy standing in the middle directing traffic. It's a 100% purely electronic market. FIFO, first in, first out. If I'm in line to buy 2 S&P contracts and Goldman Sachs is behind me looking to buy 200, I'm going to get serviced first as if I'm the only guy in line. And then when my business is taken care of, then the guy behind me, he gets his. Okay? With market makers and stocks, especially low float stocks, yeah, all kinds of monkey business goes on. So if you trade equities, you can have that myth and have that legend because there's actually some truth to it in the equity markets. But when you move over into futures, the indices, things like crude and gold, the S&P 500, yeah, you gotta put that to rest. Because remember, you wanna know what is market truth, because instead of spaghetti on your screen, you're going to use market truth to develop your narrative and to develop an understanding of what the next high probability move is. Now all you got to do is climb aboard. All aboard, heading for the zone overhead or the zone below. You can't send it there, you can't make it go there, but you can certainly go along for the ride, whichever way it's going. Okay. Okay. So we're going to go to platinum here for a moment. Let's do that again. Let's get the right month. Let's try U. Okay. Let's try Q. Let's do what I do when I want to know. Here's what I do. I go barchart.com, and at the top where it says, two ways to do it. You can type in platinum here, or you can go to the metals and find platinum. Click it, and it's going to tell you what the front month is. BLV 19. Okay, we had tried that one. GPLV. There we go. And there's a chart. Barchart.com. Plenty of other places you can do a similar thing, but that's the one I use. I'm comfortable with. Let's look on daily. From the swing high to the most recent swing low on a daily chart, we are at that 62% Fibonacci retracement. If we can trade 900, I see no problem with us making it to 910 and then 920. From here, I don't see a lot of difficulty in getting from 880 to 890. Okay. Okay. Still no pullback here. And we have a swing high of 3014.75 at the moment. And that's what's developed since the show started. We've said consider 3010 to 3012, trail if possible. Okay. It's time for a good word for the day. The blessing comes by doing. Jesus was a man of action. You may have seen the Jesus action figures. Are they sacrilegious? I don't know. I think they're fun. But he was a man of action. Whatever you think about the action figure. He was always doing something. He never just laid on the couch and watched Springer. He was out walking, talking, preaching, praying, pressing the flesh, shaking hands, kissing babies. That's how Jesus rolled. I think it's how Jesus wants us to roll. Psalm 119, verse 166 says, I do your commandments. Complete, it says, Lord, I hope for your salvation, and I do your commandments. In his book, Traveling Hopefully, Stan Mooneyham writes, I will go when I will give, after I will obey. But first, one can always find reasons for delay. And sometimes they may even seem to be valid reasons, but they're usually just excuses. We say things again like, I will go when, when certain things happen, then I'll go. Or I'll give after something. I hit the lottery, my ship comes in, whatever the case. Well, yeah, I'll obey you, God, but first, I need to take care of this. Stan writes in the book, Traveling Hopefully, a close friend of mine and I were called to preach about the same time, and we went to university together. I was out mutilating homiletics in rural Oklahoma churches during those 4 years of study, but my friend insisted he would not preach his first sermon until he had received his PhD. That was over 30 years ago. I'm still mutilating homiletics, but my friend isn't preaching at all. He never did. Preparation is important, but doing is a vitally important part of preparation. In the Old Testament, we hear much about offering our first fruits. God's portion is supposed to come right off the top. Nowadays, we are more likely to be known by and for our last fruits. Near the hold button on the hotline to heaven, these classic words would be appropriate. If not I, who? If not here, where? If not now, when? Are you waiting for the perfect moment to come before you step out in faith and actually obey what God has told you to do? Are you? Word of advice. Let's go ahead and obey God. In fact, let's go ahead and obey Him now. It's not enough to say you believe God's word. You have to obey it. See, that's what shows you really believe it, because you do it. Remember, faith is not what we believe. Faith is what we do with what we believe. There's that word, do. Doing. God wants us to be doers, not just hearers of the word, but doers. It's not enough to say you believe God's word. You must obey it. It's not enough to accumulate Bible knowledge and get a PhD. What really matters is applying the knowledge once you have it. God has given to each of us our daily living. You must apply the knowledge that God has given you to your daily living. James writes in James 1:22 and through 25, be doers of the word and not hearers only, deceiving yourselves, a doer will be blessed in what he does. But be doers of the word and not hearers only, deceiving yourselves. For if anyone is a hearer of the word and not a doer, he is like a man observing his natural face in a mirror. For he observes himself, goes away, and immediately forgets what kind of man he was. The blessing comes by doing. That's our good word for the day. Thanks so much for tuning in today. Whoever you are, wherever you are, may God continue to richly bless you with his mercy and with his grace. And I'll see you at the bell.
Remember this, there is no greater return on investment than to see a human life changed and given hope. As always, pray hard and trade safe. Any financial information discussed on this show is simply the opinion of our host, Dwayne Reeves, his co-hosts, and guests. To learn more about trading Emini Futures or to take a 1-week free trial in our live trading room, call 1-866-928-3310. 866-928-3310. Information discussed on this radio program should not be construed as a recommendation to buy or sell any security. Always do your own due diligence and consult with a licensed securities broker or financial planner before making any investment decision.